Sanlam Investments have recently launched a new range of funds designed to help investors manage the risk of investing in equities. Joining us now for more is Cobus Kruger, Managing Director at Sanlam Global Investment Solutions. Cobus, thanks for joining us. Just looking at this new product that is launched, it's new to the South African market, but not new for Sanlam. So what made you bring this international product back home to SA?
Yes, thank you, Gugu. We've been very successful with this product in the international markets, specifically in the retirement space. We see that where clients invest for retirement, pre and post-retirement, we had a lot of success with this product because of the challenges that specifically the equity market offers to clients when they invest in it. So seeing that South Africa is Sanlam's home market and the fact that we've tested successfully internationally, we thought that it would be very appropriate for this market. We know that the pension fund market in South Africa is very well run, and we identified that this product will resonate well with South African investors. So we had to go through a regulatory process to get the products approved. They come in the form of funds or unit trusts, which a South African public should be very familiar with. But because they are overseas funds, so they give exposure to overseas markets, you have to get a specific approval with the Financial Services Board under Section 65 of the Collective Investment Schemes Act to bring them to South Africa. And we've gone through that process, and a couple of weeks ago the Financial Services Board approved the funds for sale to the general public in the South African market.
Cobus, you mentioned that these are overseas funds. For the local investor, will we see any rand-denominated funds being launched anytime soon?
Yes, it's something that we will definitely consider. Obviously, we want to see what the take-up will be like in the dollar and sterling-denominated versions of the fund. But it is really very easy for us to also offer rand-denominated funds. Although it will be rands that the clients can invest in and will be able to withdraw from, they will ultimately still have the overseas exposure. We have a South African rand-based product that is separate from these funds that does something similar, already in existence, tracking the JSE FTSE Top 40 index, but they are a bit separate from these 5 funds that we're discussing today.
Cobus, walk us through the equities focus. For a lot of people, especially novice investors, who I take it will be part of your target market, they do often react emotionally when it comes to equities investments, especially because it's difficult to find key opportunities of growth at the moment.
Yes, Gugu, I think the reality is that I think we've all learned over time that equity, or a portion of equity investment, is a key ingredient for long-term returns. So especially when you're saving for retirement or even after you've retired, it's important to have a piece of your portfolio exposed to the equity market. However, what we've seen typically from clients, and I mean, time has gone by now since 2008, but the memories are still vivid in some people's memories, is that when things get tough in the market, especially when volatility picks up or there's sharp downward movements in the markets, clients and advisors typically react in an emotional way. They would typically sell out of the markets and therefore lock in losses. What we're trying to do with this investment solution is really to cushion the downside for investors. At the end of the day, when you invest in the equity market, which we have said now is a key ingredient, time in the market is a very important component. And unfortunately, this product is not a substitute for time, but what we really try and do is manage how clients would react to a sharp downturn in the market. So we want to try and give them the confidence that they can stay invested in the market, benefit from time, without engaging in that value-destroying behavior that we so often see when there is stress in the marketplace. And if you look at where we are in markets today, it's probably more relevant than what it has ever been since the global financial crisis. Markets have rebounded a lot since 2009. We see the JSE hit record highs almost on a weekly basis now. And so one has to ask yourself the question isn't now the time to continue to partake, of course, because we don't know how long this is going to continue, but maybe just to invest in something that is going to cushion the downside if maybe that comes at some point in the future.
It is a very conservative approach to investing. I take it that's why it's targeted at those wanting to plan for their retirement.
Yes, it is more conservative because the strategy that we employ to protect the investment on the downside does mean that we don't put all the money that the client would typically invest in this unit trust in the market. So typically we'll take a portion of the money and we'll put it aside where we use instruments to protect the downside. The protection in this investment is on all the time. So there is no discretionary decision from an individual or a human being that decides when or when not we will protect the investment. So the investment is protected all the time. So what that means is that if the market runs or is in a bull phase, a strong bull phase, you will underperform. But likewise, when the market is a downturn, you will not participate in so much of the downside. And effectively what you get over time, and time again is the key ingredient here, is you get a much smoother experience, a much less volatile ride, so to speak, out of the equity market. And what we have seen over the last 4 years in using this strategy internationally is that it typically gives clients more confidence to then stay in that market, stay in that investment, stay the course, and hopefully ultimately benefit from it.
Cobus, to close off with, what about the fees?
Gugu, yes, of course fees in the current environment, low interest rate, low inflation environment, but also from a regulatory perspective is under a lot of scrutiny, especially in the retirement space. So what we did is, when we created these products, is we took the opportunity to combine low cost product with the solution. So we actually use index tracking funds underneath, which is more cost effective, and then our instruments that we use is highly cost effective. So we can actually offer this investment to clients at 0.75% fee per annum, so 0.75% of the total investment. There's no initial fees, there's no performance fees, and there's no penalties if you want to disinvest from the fund. So it's completely liquid. You can trade the fund on a daily basis. So if you change your mind or your circumstances might change, you can always restructure the investment, get the money out of the investment and deploy the assets as you may see fit at any given point in time.